Obviously, with that admonition from Louis Ruckeiser, which is wise. I mean, we're modest, but we have much to be modest about when it comes to predicting. I'm going to ask you to do it nonetheless. Who knows what 2023 holds in stores? But as you look forward, what are some possible surprises that you're preparing for?
Maybe the most impactful will be the effect of the Chinese economy in its reopening, because it looks as if there's going to be a huge wave of consumption. We saw this in the rest of the world during lockdowns. People couldn't spend, but we weren't locked down to the degree they were in China. And the desire to get out and spend, to travel, to purchase is huge. And that's something that we may be underestimating. Certainly will be a plus for markets. It'll be a plus for consumer discretionary. It'll be a plus for travel and transportation. So there are parts of the global economy that could do very well as a result of that.
So let me pile on, Jim, because it's not just the reopening necessarily, but we also see, I think early on in the year at least, President Xi changing some of the policies, whether it has to do with property, for example, whether it has to do with big tech. Could we have an upside surprise out of China?
We could, but I think it would be short-lived. We're a little more cautious on the outlook for emerging markets, and especially China. Not only the COVID-related issue, and there will be a short-term bounce undoubtedly from reopening, but they've really hurt themselves intermediate and long-term competitively with what they're doing from an intellectual property and a common prosperity standpoint. Dell announced this week that they're looking to move all of their semiconductor purchases out of China by 2024 and 50% of their production. So we worry about that. We worry about the continued concerns in Ukraine with the Russia invasion and what that may mean for commodity prices. And then the final thing that we're worried about from a risk standpoint is just the risk of persistent labor strength, which leads to higher inflation and Fed policy tighter than what the market's currently expecting.
Okay, so those are some downside surprises. Yep. Can you anticipate any possible upside surprises?
Sure. The upside surprise would be that if we actually do avoid a recession and that we see inflation come down, the labor market stays strong enough, but wages are not as persistent, and we actually get to a lower inflation rate. The break-evens right now for a 2-year Treasury tips are at 2.2%. If we actually achieve that, that will give the Fed some room to pause. And then if we don't go into an earnings recession, the stock market could be definitely better than people expect. The consensus is that it's not going to be a great year.
Sarah, what about the flip side of that? Because some people think the markets may be underestimating the extent to which the Fed is going to have to raise and keep it at high levels. And we heard from some Fed governors actually this week saying we need to get to like 5.4%, Mr. Kashkari said.
It's not just the Fed's actions, and perhaps it's 5.4, could be higher, could be lower. It's the lag effect that matters. And that's something we take into consideration. Is we have to anticipate as institutional investors where monetary policy will be going and what the effect will be months, quarters, maybe years after it's implemented. So this has been one of the sharpest moves upward from zero to our current short rates, and we're going higher, as we've discussed. So that might be 12, 18 months of continued tightening effect that follows along with that. I don't think the markets are anticipating that, certainly not in the U.S.
Sarah, one of the biggest, I think, surprises of last year was geopolitical, particularly with Russia's invasion of Ukraine and the aftermath of the energy crisis that followed. As you look forward, how do you take into account the possibility of a geopolitical surprise in 2023? And that, by the way, that could be the upside or the downside.
Yeah, a rapprochement with Russia, maybe. Or it could be China invading Taiwan. There are plenty of, again, it's like the economy. You can have the positive stories and the negative ones. That really, the only way to deal with this, aside from just putting your money under the pillow, is to be well diversified. We use a quantitative model to do that. But the whole idea is you can't anticipate. When Russia invaded Ukraine, European stocks collapsed last year. They started to just fall in February and kept going. That was one of the best buys of 2022. So we can't anticipate the problems, but we can react to them sensibly and take advantage of that.
So, Jim, in anticipating on whether there's a problem or not, this last year we saw a very, very strong dollar. That seems to be coming off a bit. What if, in fact, we do see a weakening of the dollar into 23?
Well, if you were able to pair that with a strong, sustainable reopening of China, that would be a positive for emerging markets. It would be a bit of a headwind for commodities, but we look at commodities or natural resource equities as one of the hedges against the geopolitical risk that you raise, which is pretty much unforecastable, as Sarah mentioned. But then the other thing that I would say is having an overweight to cash in this environment looks pretty attractive when you can probably get a couple hundred basis point premium in cash over investment grade bonds.
And you have that overweight to cash. Is that in order to pounce when there are opportunities?
It's both. It is because we don't see anything more attractive now, but then it also will give us that dry powder when the opportunity arises.
Sarah, given your situation in equities, I know you're fully invested, you remain fully invested, but that doesn't mean you're fully invested everywhere. Where do you direct your investment toward and away?
The highest return, lowest risk stocks attract all the capital. That's where we want to be. But I would argue it's not just institutional portfolios, for individual investors too. This idea of timing markets is so appealing. It's so hard to do. That's why we really do keep in equities and keep the cash levels very low, because if you raise cash, that's one thing. You may have avoided some sort of downturn, but then you have to go back in before the upturn follows, and that's very hard to do. So staying invested is the mantra.
Sorry to interrupt you, Sarah, but what about that? What about her point? It's hard to know when to get back in.
There's no doubt that tactical asset allocation is not for the amateurs, and so you do have to be ready to go back in. You've got to have scenarios ahead of time. You've got to pay attention to valuation, and so it is something that does require a lot of resource.
So, Sarah, finally, I'll give you the last word here, perhaps, on actually having managed, really active management of your portfolio in equities. What's the case for that for 2023?
And I'm going to repeat a little bit what I said earlier, which is we have no idea where the next crisis will come from, and nor do passive indices. A passive index is a reflection of what has done well. I mean, think about the large cap stocks in the U.S. that had a tough time last year. They were what had done well. So active really implies a team like we have at Causeway out looking for opportunities and often responding to whatever situation the market is giving us. For example, last year's Russian invasion of Ukraine, or now with this China reopening and its implications globally.
So 1 minute on that, Jim. Is 2023 not the year for index funds?
I think that 2023 will be a year where active management will have a better opportunity than in the past. The volatility is likely to remain very high. We think that the beginning of the year will be people worried about an economic downturn. The second half could be a time of greater optimism and a little better tone in the marketplace. So I do think that active management should have a better time in 2023.
Sarah, it sounds like one thing everybody can agree on is volatility in 2023. Do you agree with that?
Yes, as long as we're in an environment where the monetary noose is tightening, yes, it'll be volatile.